In December 2019, a new respiratory illness known as COVID-19, caused by a novel coronavirus, was first detected in the central Chinese city of Wuhan. It's not clear how much the virus will impact investors, but the effects could go deeper than just retail and travel, hitting sectors and industries you might not expect, like energy, automotive, and banking. While there may be several factors at play, many major manufacturers have seen steep declines in share prices since the outbreak became widely reported. Banking is another industry that's facing uncertainty with the coronavirus.
We are at the very beginning of what I would consider a more fundamental change in in financial markets, capital markets overall. And I think it's very early still to talk about what the impact ultimately will be. What appears nevertheless very clearly in my mind is there will be changes. I must say in the current pandemic, the green bond has been a little bit sidelined. The Indian bond market and how it's being managed by locally, in fact also by local investors. The Indian government has also worked on that path in order to promote more sustainable investments, and notably because also these type of bonds would be snapped up, in fact, immediately by the international investor.
Financial markets across the world are experiencing intense volatility, and financial conditions have tightened worldwide.
As we all know, the COVID-19 situation has caused health, economic, and financial stability challenges. This pandemic situation has led to a sharp reversal in the portfolio flows and also highlights the challenges in managing the flows of emerging and frontier markets. The global financial conditions tends to influence the portfolio flows even more in this kind of situation than the normal times. The stronger domestic fundamentals may help in mitigating the outflows. However, the greater foreign participation in the local currency bond markets may increase the price volatility. This has affected the capital markets in a global scenario and also highlights the challenge in managing the flows of highly volatile market and ensuring the financial stability.
Financial conditions have tightened worldwide. Policy authorities have responded with emergency measures, and more recently, advanced economies have coordinated large policy rate reductions with activation of swap lines as well as quantitative and credit easing. Tentative estimates of consequent loss of global growth are currently placed in the range of 0.4 to 1.5%. Spillovers are being transmitted through finance and confidence channels to overseas and domestic equity markets. Forex and bond markets are also not immune to the current volatile conditions. There is considerable uncertainty about the duration of the pandemic, and the currently available estimates of its adverse effects will undergo sizable revisions if this coronavirus persists longer or if it gets contained much earlier than currently believed.
This is one of the big questions that everyone in or outside of financial markets is asking. Why is the stock market going up while the rest of the economy seems to be heading in the other direction?